Welcome to AI Explains ICT. This overview is going to cover the core content, Month 10, Episode 4. I really encourage you to grab something to take notes with because we'll be covering some incredibly powerful concepts today.
All right, so here's our roadmap for this video. First, we're going to give you what's essentially an X-ray view of institutional order flow. Then we'll break down two key market states you absolutely have to know. After that, we'll introduce a special tool to measure market strength. And finally, we're going to tie it all together with a super high probability trade signal and a real-world case study.
Okay, let's dive right in. We're about to explore a method from ICT that gives you a completely unique perspective on commodity markets. This is all about moving beyond just looking at candlesticks on a chart and seeing what the biggest players, the smart money, are actually doing behind the scenes.
And that quote really says it all. The key here is that this isn't about guesswork. And it's not about using some kind of lagging indicator. This is about interpreting the real, raw supply and demand pressures coming from the institutions, the folks who actually move these markets. We're basically looking for their footprint in the sand.
So, to see that footprint clearly, you first have to understand the environment. We're about to cover the two fundamental conditions, or states, that any commodity market can be in. Understanding which state a market is in is the critical first step to knowing if a huge move is even on the table.
First up, we have what's called a carrying charge market. And honestly, this is the normal state of affairs. It's what you're going to see most of the time. Just think about it logically. It costs money to store and insure a physical thing like soybeans or corn, right? So it makes perfect sense that a contract for delivery way out in the future would cost more than one for today. This is the market's default balance state.
And this example from ICT with soybeans shows it perfectly. Just look at the prices there. You've got July at $9.40, August is a little higher at $9.43, and November is even higher at $9.45. You can see that clear, steady, step-by-step increase for later delivery dates. That is a textbook carrying charge market. Nothing unusual here. But now, let's talk about the flip side. This is where things get really interesting. It's called a premium market. This is the abnormal state. It's the market screaming at you that the demand for the commodity right now is so intense that people are willing to pay more for it today than for that same thing delivered in the future.
And check this out in the feeder cattle market. See how the prices are basically going backward? The August contract is over $154, but September and October are cheaper. That backward pricing is a huge flashing neon sign of strong, immediate demand. That's what creates a premium.
So let's just put them side by side to make this crystal clear. Carrying charge, normal. Future costs more. Premium, abnormal. Today costs more. And here is the absolute key takeaway for you as a trader. Premium markets are where you hunt for those explosive, parabolic bull runs. That's the environment where they're born.
Now this is super important. ICT makes a point to clarify this, so listen up. The premium market condition we're talking about here is a fundamental concept about the entire market. It has absolutely nothing to do with the price action concept of a premium or discount part of a trading range, the PD arrays. They're two completely separate ideas. You have to keep them distinct in your mind.
Okay, so we know how to spot a premium market, but so what? How do we measure its strength? How do we use it to our advantage? Just knowing a premium exists isn't really enough. We need a way to quantify it to see if it's getting stronger or weaker.
And that question leads us directly to a specific tool that does exactly that. We need something that can act like a magnifying glass, showing us whether that big money institutional demand is ramping up or dying down. And we need it to work no matter what the price chart itself is doing.
And the cool thing is, you can build this tool yourself for free. According to ICT, you just go to barchart.com and follow these simple steps. All you're really doing is plotting a chart of the nearby contract price minus the price of the next month's contract. It's a really simple calculation, but it reveals a ton of information.
So what this chart is actually showing you is simple. It's a visual representation of the premium strength. Think of it like a strength meter. When the line on this chart is rising, it means institutions are getting even more aggressive. They want that commodity now, and they're willing to pay an even bigger premium to get it.
All right, now this is where it all comes together. This is the fun part. We've got our premium market condition, we've got our spread chart tool. Now let's combine them to find a real high probability trade signal. This is where the magic really happens.
This right here, this is the light bulb moment. I want you to picture this. The price on your regular chart is falling, making new lows.
It looks weak, it's scaring everyone out. But underneath the surface, our special spread chart is actually creeping up, making higher lows. What does that tell you? It tells you that while price is dropping, the smart money is quietly and aggressively buying. They're absorbing all the selling with conviction. That's divergence. Okay, that sounds great in theory, right? But let's see how this actually plays out in the real world. Theory is one thing, but seeing it on a chart makes it real. And ICT gives us this fantastic case study in the cotton market.
So, step 1, what do? We check the market state. We look at the contract list, and you can see right here, the nearby July contract was at $76.18, and the October contract was cheaper at $74.51. Boom, that's it. Checkbox number 1 is ticked. Cotton is in a premium market. The stage is set.
And now, look at this. This chart is the money shot. You can see the candlesticks for price. They're clearly making lower lows in May, right? Looks bearish to the untrained eye. But that black line overlaid on top, that's our spread chart. And look at it, it's making higher lows. That is the exact bullish divergence we've been talking about. As price got weaker, institutional demand got stronger.
Now, the really beautiful thing here is that this powerful divergent signal wasn't just happening on its own in a vacuum. It was lining up perfectly with a whole bunch of other key ICT concepts. We had the premium market condition, price was trading down into a discount array and hit a bullish order block. It even ran the sell stops below the April lows. And then, on top of all of that, we got our bullish spread divergence. It was a textbook, A+, high probability setup.
And what happened next? Well, just look at the chart. That beautiful alignment of all those factors, it preceded this massive, powerful, parabolic move to the upside. That divergence was like the final piece of the puzzle, falling into place, signaling that a major turning point was here.
And we're not talking about a small move, we are talking $5,000 per contract in less than a week. That just highlights the incredible power you can tap into when you stop just looking at the surface level price and you start seeing what the institutions are actually doing with their order flow. So, to wrap this all up, you start by identifying a premium market. Then you use that spread chart to hunt for divergence. That alone gives you a massive edge because you're trading in alignment with real fundamental institutional flow. But I want to leave you with a question to chew on. If this bullish divergence signals buying strength, what might it mean if you see the opposite? What if price is making a higher high, but the spread chart is making a lower high? What could that tell you about the true strength of that rally?
If you found this video valuable, please do us a favor and like this video and subscribe to the channel. If you have any questions at all, leave them down in the comments and a real human will get back to you. Safe trading!